Good morning, everyone. I am Dr. Sumi Khurana from Ajay Kumar Garg Institute of Management. Today, I am going to discuss Unit 1 of Financial Market and Services. In this, we are going to discuss first what do we mean by financial system, then their functions, importance, and components. The economic development of a nation is reflected by the progress of the various economics units, broadly classified into the corporate sector, government sector. They are the areas of the people with surplus fund, and they are those with the deficit. A financial system is the composition of the various institutions, market, regulations, laws, practice, money manager, analyst, and the transactions. Financial system comprises of the set of subsystem of financial institutions, financial markets, financial instruments, and services which help in the formation of the capital. It provides a mechanism by which savings are converted into the investments. In a simple words, we can say financial system allocates savings efficiently in an economy to ultimate users either for investment in the real assets or for a consumption. It facilitates the flow of funds from the area of surplus to the area of deficit. It is concerned about the money, credit, finance. In other words, we can say financial system consists of a variety of institutions, market, and instruments related in a systematic manner and provide the principal means by which savings are converted into an investment. Now, the next one is the functions of the financial system. The first function is the savings function. This is very important function of the financial system. Under this system, funds are mobilized and channelize them into the productive activities. It is through financial system the savings are converted into the investments. Second function, liquidity. In the case of the liquidity, it provides money and monetary assets for the production of goods and services. Monetary assets are those assets which can be converted into the cash or a money easily without loss of value. All activities in a financial system are related to the liquidity, either provision of liquidity. Third function is the payment. The financial system offers a very convenient mode of payment for goods and services. The check system and the credit card system are the easiest method of payment in the economy. Fourth is the risk function. The financial market provides protection against life, health, and income risk. These guarantees are accomplished through the sale of life, health insurance, and property insurance policies. Fifth one is the information function. Again, this is very important function. Each and every investor wants some kind of information for taking the financial or the economic decision. And the financial market disseminate the information for various participants and also help them to take the information on a regular basis. Seventh one is the reformatory function. A financial system makes available price related information, and these are very important. If we are consider about the reformatory function, a financial system undertaking the functions of developing, introducing innovative financial assets and practice and restructuring the existing asset services to cater the emerging needs of the borrowers and the investors. One is missing, the one we have missed, that is the transfer function. A financial system provides a mechanism for the transfer of the resources across the geographical boundaries. In the case of the other function, it assists in the selection of the project to be financed and also review the performance of such projects periodically. If we will discuss the role and the importance of the financial system in the economic development, it links the savers and investors. It's help in mobilizing and allocating the savings efficiently and effectively. It plays a crucial role in the economic development. It also helps in monitoring the corporate performance. It also helps in the mechanism for managing the uncertainty and controlling the risk. It provides a mechanism for the transfer of the resources across the geographical boundaries. It offers portfolio adjustment facility also. It helps in lowering the transaction cost and increasing the returns. It promotes the process of capital formation. It helps in promoting the process of the financial deepening. Financial deepening means increasing the financial asset as a percentage of the gross domestic product. In short, financial system contributes to increase the growth of the economic development through the technical progress. Now, the next is the financial system. It is consists of four, that is financial market, financial services, financial instruments, and financial institutions. Now we will discuss one by one all of them. The first one is the financial institutions. Financial institutions are the participants in the financial market. They can be investors, they can be the public, anyone can play an can work in the financial market. They are the business organization who are dealing in the financial resources. What they will do, they are collecting the resources by accepting the deposit from the individuals and institution and lend them to trade, industry and others. They buy and sell the financial instruments. They generate the financial instruments as well. They deal in the financial assets. They accept deposits, grants, loans, and invest in the securities. Financial institutions are the business organizations. I have already discussed this thing. They have do the number of things. On the basis of the nature of the activity, financial institution may be classified as a regulatory banking institution, non-banking institutions. In the case of regulatory, financial institutions, financial markets, financial instruments, and financial services are all regulated by the regulators like Ministry of Finance, the Company Law Board, Reserve Bank of India, SEBI, Department of Economic Affairs, Department of Company Affairs. The two major regulatory and promotional institutions in India are Reserve Bank of India and the Security Board of the India. Both RBI and the SEBI administer, legislate, supervise, monitor, control, and discipline the entire financial system. RBI is the apex of all the financial institutions in India. All the financial institutions are under the control of RBI. The next one is the banking institution. Banking institution mobilize the savings of the people. They provide a mechanism for the smooth exchange of goods and services. They extend credit by lending money. They not only supply credit but also create credit. There are the three basic categories of banking institutions. They are commercial banks, cooperative banks, and development banks. The next one is the non-banking institutions. The non-banking financial institutions also mobilize financial resources directly or indirectly from the people. They lend the financial resources, mobilize, they lend funds but do not create credits. Companies like LIC, GIC, Unit Trust of India, development financial institutions, organization of pension and provident fund fall in this category. Non-banking financial institution can be categorized as investments company, housing company, leasing companies, hire purchase companies. Our next topic is the financial market. Financial market are another part or the components of the financial system. Efficient financial markets are essential for the speedy economic development. The vibrant financial market increase the efficiency of capital formation. It facilitates the flow of savings into the investments. Financial market bridge one set of financial intermediaries with another set of players. Financial markets are the backbone of the economy. You can say financial market deals in financial securities. Financial market exists whenever there are financial transactions take place. Financial transactions include issue of equity stock by the company, purchase of bonds in the secondary market, deposit of money in the bank account, transfer of the funds from the current account to a saving account. The growth of the financial market is actually the barometer of the growth of the country's economy. The participants in the financial system are corporates, financial institutions, individuals, and the government. These participants trade in the financial products in these markets. They trade either directly or through brokers and a dealer. In short, financial market is the market that deals in the financial assets and credit instrument. We can say that it facilitates the creation and the allocation of credit and liquidity. It acts as intermediaries for mobilizing of the savings. It helps the process of the balanced economic growth. It provides financial convenience. It also provides the information and facilitate transaction at a lower cost. It caters the various credit needs of the business organization. Next one is the classification of the financial system. There are the different ways of classifying the financial assets, and there are mainly 5 ways of classifying the financial assets. First one is the nature of the claim. On the basis of the nature of the claim, we can divide that market, equity market. On the basis of maturity of claim, we can divide money market and capital market. On the basis of time of delivery, we can divide cash market and future market. Next, on organizational structure, this is again divided into 2 parts, exchange traded market and over-the-counter market. Let us discuss one by one. The first one is the classification on the basis of the type of the financial claims. This is debt market and the equity market. In the case of debt market, this is the financial market for fixed claims like a debt instrument, debentures. In the case of equity market, this is the financial market for the residual claim, that is the equity instrument. Then classification on the basis of the maturity of claim. On this basis, financial market may be further divided into 2 parts, money market and capital market. In the case of money market, a market where short-term funds are borrowed and lent, it is called money market. It deals in the short-term monetary assets with a maturity period of 1 year or less. Liquid funds as well as the highly liquid securities are traded in the money market. Example of the money market are treasury bills, call money market, commercial bill market. The main participants in this market are banks, financial institutions, and government. In short, money market is a place where demand for and the supply of the short-term funds are met. The next one is the capital market. Capital market is the market for the long-term funds. This market deals in the long-term claims, security, and stock with a maturity period of more than 1 year. It is a market from where productive capital is raised and made available for the industrial purpose. The stock market, the government bond market, and derivative market are the example of the capital market. In short, capital market deals with long-term debt and the stock. Capital market is again divided into two parts. One is the primary market and the second one is the secondary market. Primary market are those markets which deals in new securities. Therefore, they are also known as new issue market. These are markets where securities are issued for the first time. In other words, these are the market for the securities issued directly by the companies. The primary market mobilizes the saving and supplies the fresh or additional capital to business units. In short, primary market is a market for raising the fresh capital in the form of shares and debenture. Secondary market. Secondary market are those markets which deals in existing securities. Existing securities are those securities that have already been issued and are already outstanding. Secondary market consists of stock exchange, NSE and BSE. Stock exchange are self-regulatory bodies under the overall regulatory supervision of the government and the SEBI. The next one is the classification on the basis of the structure or the arrangement. On this basis, financial market can be classified into the organized and market and unorganized market. Uh, these are the financial market in which the financial transactions take place within a well-established exchange or in a systematic and orderly structure. In the case of unorganized market, these are the financial market in which the financial transaction take place outside the well-established exchange or without the systematic or orderly structure or arrangement. These are the cases. Now the classification on the basis of the time of the delivery. On this, financial market is maybe again classified into the two parts. One is the cash market and the second one is the future market. Cash market is known by another name that is known as the spot market. This is the market where the buying and the selling of commodities happens, or stocks are sold for cash and delivered immediately after the purchase or sale of commodities or securities. Forward or the future market. This is the market where participants buy and sell the stocks or the commodities. Contract and delivery of the commodities or the security occurs at the predetermined time in the future. Last, organized structure. Again, it is divided into two parts. One is the exchange traded market and the second one is the over the counter market. Exchange traded market is a market where the well settled rules are there, but in the case of the over the counter market, this is the market which is customized. There is no well settled uh, exchanges there. And this is all about the financial market. Let us go further. That is known as the financial institutions. Financial institutions are the financial assets, securities, and the claims. They may be viewed as the financial assets and the financial liabilities. Financial assets represent the claims for the payment of the sum of the money sometime in the future and or a periodic payment in the form of interest or dividend. Financial liabilities are the counterparts of the financial assets. They represent promise to pay some portion of the prospective income and wealth to the other. Financial assets and liabilities arise from the basic process of financing. Some of the financial instruments are tradable, or we can say that it is transferable. Others are non-tradable or non-transferable. Financial assets like deposit with banks, companies and post office, insurance policies, national savings certificates, provident funds, and the pension funds are not traded, you know very well. Securities, including in the financial asset like equity shares and the debentures or a government security and bonds are tradable. They can be easily transferred from one person to another and they are easily transferable. In short, financial instruments are instruments through which a company raises the finance, through which a company raises their capital. The financial instrument may be the capital market instruments or the money market instrument or the hybrid instrument. Hybrid instruments are those instruments which include both debt and equity. The instruments that are used for raising the capital through the capital markets are known as the capital market instruments. These include first is equity share, preference shares, warrant, debentures, and bonds. These securities have a maturity period of more than 1 year. The instruments that are used for raising and supplying the money in the short term period not exceeding 1 year to the money market are called money market instruments. Example are treasury bills, commercial bills, call money, short notice money, certificates of deposit, commercial bills, money market mutual fund. And we will discuss all these in the money market instrument chapter. Uh, Next one is the hybrid instruments are those instruments which have both the features of equity and debenture. Example are convertible debentures. Convertible debentures are those debentures which can be converted into the equity after a certain period of time. First, they are in come under the category of the debt capital. After that, they can transfer to the equity. Financial instrument may also be classified as the cash instrument and the derivative instrument. Cash instruments are the financial instruments whose value is determined directly by the market, and derivative instruments are those instruments whose value is derived from the underlying asset. Next one is the what are the certain characteristics of the financial instruments. The first one is the liquidity. We have discussed so far the liquidity plays a very important role, and with the help of the financial institution, it provides the liquidity. These can be easily and quickly converted into the cash. Marketing financial instruments facilitate easy trading on the market. They have ready market. Collateral value. Financial institutions can be pledged for getting the loans. Transferability. Financial instruments can be easily transferred from one person to another. And the maturity period of the financial instrument may be the short term, medium term, or the long term. If it is for the short term, then it is known as the money market, and if it is long term, then it is known as the capital market instrument. Financial instruments also involve buying and selling costs. The buying and selling costs are called transaction costs. These are low. Financial instruments carry the risk. This is because there is an uncertainty with regard to the payment to the principal or interest or dividend as the case may be. Future trading. Financial instruments facilitate future trading so as to cover the risk due to the price fluctuation, interest rate fluctuation, etc. Our next topic is the financial services. The development of the sophisticated and the mature financial system in the country, especially after the early 19s, led to the emergence of the new sector which is known as the financial services. Its objective is to intermediate and facilitate the financial transactions of individuals and the institutional investors. The financial institutions and the financial markets help the financial system through the financial instruments. The financial services include all the activities which are converted with the transformation of savings into the investment. Important financial services include leasing, financing, hire purchase, installment, payment system, mechanism, then banking, factoring. All of these come under the financial services. Thank you very much. Thanks a lot. In the next lecture, I will discuss the growth and development of the Indian financial system, weakness of Indian financial system, and the theories of financial system. Thank you very much.